Welcome to the deep dive. Today, we're really digging into some source material that you shared with us. We'll be focusing specifically on insights into, well, several Indian exchange-traded funds.
That's right. Yeah, our focus today is what your source material discusses regarding three ETFs in particular, ITBs, the CPSE ETF, and the Oil I ETF.
Okay, so the mission is pretty clear then. We're going to try and unpack the analysis, the observations, and the investment strategies that are presented in this source material.
The goal is to give you a really solid understanding of the points being made about these specific funds.
Definitely.
And it's probably important to, set the context here. The speaker in your source material, they're sharing insights based on their own history, their past calls,
Right.
their current market reads, and just personal experience. They do give specific price points, specific strategies.
But these are their observations, right, from the source itself.
Exactly. It's crucial to remember that. And, something that comes up repeatedly in the source.
Let me guess, the advisor point.
You got it. The source constantly emphasizes that you really should consult your own financial advisor before you make any actual investment moves. Everything we discussed today is just drawn from that material you provided.
Okay, good clarification. So where should we start? ITBs.
Sounds good. Let's unpack ITBs first, ticker ITB20. The source delves into this one quite a bit.
And the source speaker mentions some history with it.
Yeah.
Something about past advice.
Yeah. They bring up having previously suggested buying it around the 36.37 mark.
Okay.
And then looking to potentially sell around 41, 42. More of a short-term gain idea, it seems.
Gotcha. And where is it now, according to the source?
Well, based on the material, the price is currently hovering around 40.25. The source also notes the expense ratio, that's the annual fee, around 0.22%. PE ratio is 28, price to earnings, and the AUM, the assets under management, is roughly 2,200 crore.
Okay. Now, the source mentioned something about technicals, a huge resistance.
Yes, exactly. They really flag this area around 41, 42, and 43 as being, huge resistance for ITBs.
And how does the source define that resistance in an ETF context?
It's pretty straightforward in their definition, just a price level where the ETF seems to repeatedly hit a ceiling and pull back from, like a barrier it's struggling to break through.
Okay, makes sense. What about the bigger picture? Market context, AI.
Right, the source kind of muses about that, ponders the real impact of AI, and whether this ETF might just be settling into a longer sideways pattern.
Like going nowhere fast.
Potentially, although the source does mention the reported one-year return is 14%. But the implication seems to be that longer-term returns haven't been that stellar recently, maybe suggesting this correction or, sideways phase is happening.
But it's not totally flat, right? Didn't the source mention swings?
Oh, yeah, that's a key point they make. Even within this sideways idea, the source points out you can still get these pretty significant swings, like 20, 30%, maybe within a year or so.
So it's about navigating those swings then.
Yeah, that's what the source suggests, yeah. Understanding how to potentially trade those swings is presented as important.
So, wrapping up on ITB's strategy from the source, what's the takeaway?
Well, the source talks about long-term churning opportunities. Seems to be a concept linked to the speaker's other programs, maybe implying buying and selling within a range.
Okay. And for new investors?
For totally new investors, the source suggests maybe considering SIPs, systematic investment plans. But, and this is a big but in the source, only after talking to their financial advisor.
Right. Always the advisor check. Okay, let's shift gears. What about the Oil I ETF?
Okay, Oil I ETF. The source introduces this one as like an alternative to picking individual oil and gas stocks directly.
Because those can be tricky.
Yeah, the speaker in the source notes that direct stocks in that sector, they can often have these really long flat periods, maybe followed by quite severe corrections. So the ETF is positioned as another way in.
Got it. What are the numbers on this one, according to the source?
Okay, stats provided are price around 11.45. Expense ratio is a bit higher, around 0.40%. PE ratio is 14, and the AUM is, relatively smaller compared to others, about 162 crore.
And the chart. What does the source say about the chart analysis?
Interestingly, the source notes the chart might look bullish at first glance.
Always a but.
Yeah. But based on the source speaker's personal experience, and they're very clear in adding a caveat, I could be wrong, check with your advisor, their prediction is it'll probably pop up a bit, then come back down again.
It's range bound.
That's the expectation laid out in the source, yes. That this ETF might just get stuck in a range, specifically between about 9 and 0.
For how long?
Potentially for a significant amount of time is the phrase used. The source even suggests it could be quite frustrating for investors, go so far as to say it might make you cry.
Oof. Okay, strong words. So the strategy advice here.
Well, if you're already in it, the source's point is just be aware of this expected range. Know what you might be in for.
And if you're thinking about buying,
If you haven't bought yet, the source is pretty cautious. It advises only considering SIPs. And it's a big if you have a genuinely long-term view. They specifically mention 3 years.
3 years minimum.
That's the suggestion in the source. Otherwise, the advice leans towards maybe just staying away altogether.
So not a short-term opportunity in their view.
No, they call it a long-term horse in the source. Needs patience, and probably requires you to have a real interest in the oil and gas sector itself for it to make sense.
Okay, clear enough. Let's move to the third one. The CPSE ETF. This one sounds like it has a bit of a story according to the source.
It really does, yeah. The source speaker makes a point of saying they had consistently, for about 8 months straight, told people to steer clear of this ETF.
Stay away for 8 months? Wow. Why? Did it run up a lot?
It had a big run, yeah. Hit a high somewhere around 105 euro, 106.
And
then a correction. The source mentions a 15-25% drop, and apparently a lot of investors are now feeling stuck.
Stuck, how you mean?
Exactly. Though the text does add that it's showing some signs of recovery now.
Okay, so what are the current stats? Price, AUM.
Right. Current stats from the source. Price is around 91. Actually, 91.7 is mentioned specifically. The AUM is massive on this 137,000 crore.
Whoa, okay.
Expense ratio is super low, around 0.07%. And the PE ratio is about 13.75.
So technically speaking, where does the source see it now? Resistance again.
Yep, resistance is the key word again. The source identifies the 91, 92, 93 zone as a very big resistance area right now.
But wait, if they said stay away for 8 months and now it's hitting resistance, are they still saying stay away?
No. And this is the interesting bit. This is where the source reveals a change in stance.
Oh.
The speaker now says they are advising listeners to add the CPSE ETF to their watch list.
A watch list candidate now, after telling people to avoid it.
Exactly, a definite shift. The source implies their students would understand the reasoning behind this change.
Interesting. What about performance history? The source mentioned the recent drop.
Yeah. The source notes basically no return over the last year because of that correction. But then it adds that if you look back at the last 5 years of data, well, the source says looking at that would be very enjoyable.
Implying it was very strong before the recent pullback.
That's the strong implication, yes. A good long-term performer prior to this correction phase.
Okay, so what's the outlook and strategy now, according to the source? Correction over.
The source suggests the short-term correction looks like it's near completion. However,
Always a however.
always a however. There's a note of caution. If the price drops back below 88, maybe heads down towards 85,
Then what? More pain.
then the source warns pain could still be on the cards. But they clarify it's likely more time correction pain.
Time correction, meaning it just goes sideways for ages.
That seems to be the idea presented, enduring a prolonged flat period without necessarily big price drops, but still frustrating if you're waiting for gains. More so than another sharp price fall is the implication.
Okay, so time versus price correction.
Yeah.
Got it. So for people already holding it, feeling stuck.
Right. For those folks who the source suggests have already weathered the price drop and maybe some of this time correction,
Yeah.
the speaker suggests that now might be a time when SIP investing could potentially be considered again.
Okay. But with the usual disclaimer.
Absolutely. They hammer home the point again. Consult with your financial advisor before doing anything.
Right. It feels like that's the main takeaway weaving through all this analysis from the source.
It really is. No matter the ETF, no matter the technical levels or the speaker's opinion, the constant refrain in the source material is the absolute necessity of getting personalized advice from your advisor.
Because the best strategy isn't one size fits all.
Exactly. The source makes it clear it depends entirely on your situation. Are you a new investor? Are you already in and feeling stuck? What's your actual time horizon? Short-term swings or long-term hold? All that matters.
And the source speaker also mentioned their own trading programs for more detail, right?
They did, yeah. Referred people there for deeper dives into the specific strategies they advocate. And, they finish with that typical call to action, like, comment, subscribe to boost visibility, standard stuff.
Okay, so let's try and quickly recap the key points we pulled from the source on each ETF.
Sounds good. So for ITBs, the source highlighted those resistance levels around 41 euro 43, but also the potential for swing trading within what they see as maybe a sideways market.
Right, and for the oil ETF.
That one was framed as potentially volatile, likely range-bound between roughly 9 and 12 for maybe a long time. The key takeaway from the source was needing a very long-term horizon, like 3 years plus, or maybe stay away.
The long-term horse.
That's the one.
Yeah.
And finally, the CPSE ETF. The source suggested the short-term correction might be nearly done, but flagged immediate resistance around 91 euro on 93, and also warned about potential time correction if it dips below 88 again. But now, maybe one for the watch list, and SIP is possibly viable for those already stuck, advisor permitting.
Okay, and underlying all of that analysis from the source is that constant theme. You absolutely need to blend this kind of market perspective with your own personal financial situation.
And always, always loop in your financial advisor. Can't stress that enough, based on the source material.
Definitely. This whole discussion drawing from the source about not just price levels, resistance points, but also this concept of time correction.
Yeah, the pain of just waiting through flat periods.
Right. It's distinct from worrying about price drops.
Yeah.
It brings up a really interesting thought, doesn't it?
It does. What are you thinking?
Well, just think about this provocative idea, kind of extending from the source's points. How does truly internalizing both sides of that, the specific price levels, the source flags as potential hurdles or floors, and the very real chance an investment might just tread water for a long time, how does that fundamentally shape how you approach investing, even with something diversified like an ETF?
It adds another dimension, doesn't it? It's not just about risk of loss, but also the risk of, well, stagnation. The opportunity cost of your money sitting there. Managing patience becomes just as crucial as managing price risk.
Exactly. It's about understanding the potential for that slow grind, not just the ups and downs, something definitely worth mulling over.